Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
The other nice thing about a will versus a trust is, generally speaking, a will take about 9 months to a year to probate. Even the fastest, simplest estate will take about 9 months to a year from beginning to end. During that time period, you've got real estate costs that are continuing to accrue, whether it's interest on any debt service, taxes, insurance, maintenance, upkeep. And for a time period, those properties are kind of locked. So they can't, there's really nothing can be done until the court appointment. That can take a couple of months. Whereas with a trust can be administered as fast as people want to administer it. Some trusts done in 30 days. Some trusts take a year. But it depends on how quickly people want to move. The other nice thing about a trust, this kind of goes back to the government changing the tax laws, is that the trust has flexibility built into it. When a probate case hits the judge's desk, the first thing they want to do is get that probate case off their desk, because they've got more coming in, they don't have time for them to stack up. So judges may say, we want this property distributed on December 1st. I don't really care, just get it out and distribute it. Once the distribution takes place, there is a potential taxable event that occurs, and maybe the tax laws aren't very favorable on December 1. Maybe they're going to be more favorable on January 2. So with a trust, your trustee has the flexibility to hold off on distribution, because there's nobody pushing the trustee other than the beneficiaries. So if it makes sense to distribute on December 1, the trustee can do so. If it makes sense to wait till January 2, trustee can do so. So trusts just provide a lot more flexibility for what you're trying to accomplish. Now, before I take any questions on wills and trusts, one of the myths that I do want to dispel, because I know a lot of your real estate investors are concerned about asset protection. The type of trust I'm talking about does not provide any asset protection. Now, you can call your trust whatever you want, and it can be used to kind of hide the true ownership. In fact, a lot of celebrities will buy homes in a trust here in Tennessee, so you don't know that Blake Shelton owns, a particular property. But these trusts don't provide any asset protection. So they're not like an LLC or a corporation. They are completely see-through. There is no impediment. There's nothing protecting you or your assets by virtue of this trust. The trust I'm talking about is strictly means to pass assets at death, and that's what it's designed to do, and that's what it'll accomplish. So before we get to talking about evictions and landlord-tenant stuff, any questions either online or from the audience about wills and trusts? Yes, sir.
And repeat the question.
So the question was, what are the annual costs to maintain a trust? Realistically, if your trust is set up correctly, it should be really $0 to maintain the trust, because most of the maintenance can be done by the trustor. So there's 3 parties to a trust: a settlor, trustee, and a beneficiary. The settlor is the one that creates the trust. So if you were to create a trust, that would be you, and that would never change. And so as a settlor, you can manage that trust. And so there's very little upkeep that needs to be done if it's set up appropriately at the beginning. So in terms of maintaining the trust, your job is to make sure that assets you acquire end up in the trust one way or another. Now, most real estate investors, especially if they have sizable holdings or they own commercial property, will do so in an LLC or corporation. But there's ways to get those membership certificates or those corporate shares into the trust. Your job is to make sure that if you acquire a new property, that property gets into the trust one way or another. That might involve a 5-minute phone call to your favorite neighborhood attorney and say, hey, I bought this property, what do I do with it? And if the attorney is competent, most attorneys that do wills and trusts are, I'm not saying they aren't, but they should be able to tell you in 5 minutes, oh, here's what you need to do. And it's not that complicated. So one of the nice things about trust, and thank you for asking that staged question, one of the nice things about trust is that they are easy to maintain. They aren't difficult. So there really isn't much maintenance. The only times you'll really change a trust is if you want to change who's going to manage your trust when you're gone, or if you want to change where your trust is going. But once the trust is set up, it really should not be an extensive cost going forward. Yeah, thank you. Great question. Yes, Jen.
If the beneficiaries opt to divide or to sell off the contents of the trust, does the trust automatically dissolve if there's no assets?
So yes. So the question was, if the trust assets are all sold off, and there's nothing in the trust, does the trust automatically dissolve? And the answer is, as a general rule, yes. Again, not giving tax advice, but there is usually a tax return that must be filed within 9 months of when somebody passes away. So even if you administer that trust very, very quickly, there's likely going to be at least a state tax return that would have to be filed to formally close out the trust. But closing out the trust does involve just distributing assets out. So if I'm managing the trust and you've got 5 properties and you want the 5 properties to go to 5 different people, it really just involves me doing a deed to transfer the property from your trust to those individuals. And it takes 30 minutes to prepare a deed. You record at the recorder's office, that's it. Bank accounts, you distribute cash out. And that's what I'm talking about, that flexibility that a trust has. So if I'm the trustee and the kid's like, hey, listen, I don't want to take the distribution now because either I don't want to manage it right now, or I got a big tax year this year, so let's defer it to next year. As a trustee, I can go, okay, we can wait. There's no rush to distribute. Whereas if we're in a probate case and the judge has set the distribution hearing for May 15th, then on May 15th, we're going to distribute because that's when the judge wants that distribution. So thank you, Jenna. Good question. Any other questions? Yes, sir.
Oh, like you touched on it. So if you're using LLCs for liability protection, what's that? How do those work together?
Sure. So the question is, how does an LLC work together with a trust? So an LLC is mainly designed for asset protection. There's some tax benefits to it as well, potentially, depending on your situation. But the primary purpose behind an LLC is for asset protection, to give the owner some protection, both in terms of whether their personal assets can be reached, and it also provides protection in terms of who the real owners are, because you can name your LLC whatever you want. A lot of people will come together, form an LLC, and that is what becomes the face of the company, and the individual owners are really unknown. Individual owners own either shares in a corporation or membership certificates in an LLC. So if you and I form an LLC together and you have 50% and I have 50% of the membership certificates, my certificates would go into my trust, your certificates would go into your trust. Now, if an attorney drafts your articles of incorporation or your membership agreement, it's a good idea to have something in there about what happens to your shares if you pass away. Because here's what happens if there's nothing in the agreement between him and I. I'm sorry, I didn't catch your name. Yeah. What's your name? Frankie. So if Frankie and I form a partnership together, and I've got my shares, he's got his shares, and there's nothing in our agreement about what happens to those shares, if I pass away and I'm single at the time, those shares will go to my 4 kids. So all of a sudden, Frankie finds himself in business with 4 people he's never met and knows nothing about, and may or may not know anything about the business. But he needs their permission before he does anything with it. So whoever has drafted whatever your operating agreement is, make sure they've included some provision there about what happens with your shares. Usually it's going to be some kind of buy-sell or right of first refusal, but you kind of want to make sure those shares don't get passed down to people that you don't know or that maybe don't know how to run your business. So that's something that's how that works together. So the shares would go into the trust, and the trust would determine how those ownership shares get distributed out, or the partner. So in my case, well, I'll kill you off, Frankie. So you pass away, then I would come in and buy your shares. So we've got a $20 million corporation because we're really good at what we do. And so your $10 million, I would buy that from you. $10 million would go into your estate, into your trust, to be distributed out where you want it to go. And those membership certificates would then all come to me. It is how those work together. So good question. Thank you, Frank. Any other questions on that? Yes, Jim.
I have 2.
Okay.
Completely unrelated. First question is, can foreign entities enter into domestic trust? Is there laws prohibiting that?
So the question was, can foreign entities enter?
Specifically real estate related.
Yeah, so the question was, can foreign entities enter into the trust? Yes, there's special rules that have to be, or there's special rules that apply if it's a non-U.S. citizen. So again, if the attorney that you're using is competent in estate planning, then they'll know that there's special rules that apply, and there's special language that has to go into a trust if it's a non-citizen that does so. But yes, it can be done.
We deal with a lot of people who have family members who invest in the United States, but their family members are not from the United States.
It can be done. Just there's special rules that apply. It's a little bit more complicated than if it's an American citizen doing the exact same thing. Okay.
And this is a little obtuse, I apologize, but I think it's going to demonstrate something that you do that I think is unique. What about real estate trust and inheritance when you have a child who's disabled?
So the question was, what about real estate trust and inheritance if you have a child that's disabled? So The trusts I'm talking about they go by different names: revocable trust, living trust, revocable living trust. So that's a terminology you hear most often. If you Google trust or pass my assets to death through the trust, that's what'll come up. Jana's question is really more around what's called the special needs trust. So most of the people that have a child who is disabled or has special needs, whether that's autism or they're paralyzed from the neck down, or any number of things, where they rely upon government benefits or government health care, where they're receiving some kind of benefit from the government through Medicare or TennCare or something like that, there's limits to how much they can own. Those limits are like really low. I can't remember, I think it's like $1,200 is the most they can have in their bank account or something, or their income can only be like $1,200. I mean, it is really just almost nothing. So what people can do is they can create what's called a special needs trust. What that is, it's a special trust. So all the trusts I talked about for the past 30 minutes are revocable. A special needs trust is irrevocable. So a special needs trust is closer to a corporation or an LLC, and that it's its own separate entity. It gets its own tax ID number. It may have to file its own tax return. But the benefit to the special needs trust is you can put as many assets in there as you want. The beneficiary of that special needs trust is that disabled child. Now, because the money's held in a special needs trust, which is like a corporation, the disabled child doesn't actually own it. So it doesn't count against that child for purposes of determining whether or not they qualify for government benefits. So you could have $1 million in a special needs trust. You're a trustee, and you decide who the trustee is going to be. It can be whoever you want, as long as they're over 18 and competent. Your trustee is then responsible for using the assets of the special needs trust for the benefit of that child. So now the family wants to take the child to Harry Potter World. The assets of the special needs trust can be used to buy the tickets, purchase the airfare, pay for the hotel, rent the car, buy the food. If the child wants to, have a particular set of clothes that might be more expensive than what they can afford on their limited allowance, then the special needs trust can buy the clothes to the child and give the clothes to the child. So there's a way, if you have a beneficiary, whether that's a blood relative, adopted relative, or just somebody that you know and love, that is on government benefits and can't inherit because they'll lose their benefits, a special needs trust is a way to set that up so you can give them something that they will be able to use without disqualifying them from their government benefits. So good question, John. Thank you. Any other questions? Yes, sir.
The revocable living trust that was formed in Texas, valid in Tennessee.
So yeah. So the question was, is a trust that was formed in Texas valid in Tennessee? So that depends on two things. One, if the trust was valid under Texas law, then it's going to be valid in all 50 states. So there's two requirements for that. One is that the trust has to specify what law is going to govern that particular trust. So every trust, even if you get one off of Quicken or LegalZoom or whatever, will have a paragraph in there that says this trust is to be governed under the laws of the state of whatever. Each state has its own unique requirements as to what you need to do to execute a valid trust or a will. For example, in Tennessee, if you're doing a will, you need 2 witnesses, and those 2 witness signatures need to be notarized. I don't know why, they just did. In California, it's 2 witnesses and no notary. If you notarize a California will, that is not a valid will in California. So you can see how the 2 state laws completely conflict with each other. So what the rule is, if it's a valid will in Texas, even if it would be or a trust in Texas, even if it would be invalid in Tennessee, under Tennessee law, that's still going to be a valid trust. So what they do is they look back at the state law, in your question, Texas, and they say, is this trust a valid Texas trust? If yes, then Tennessee will honor it. And so one of the ways, that actually leads you to another great question, Pat, that I forgot topic I forgot to talk about real quick. With a will, if you do a will, if you have property in multiple states, you're going to have to do a probate in each individual state, because Tennessee only has jurisdiction over property in Tennessee. Kentucky only has jurisdiction over property in Kentucky. So if you got property in Tennessee and Kentucky, even if they're a mile apart, you're doing a probate in Kentucky, you're doing a probate in Tennessee. With a trust, you can put all of your assets into the trust, and again, because it's a valid Tennessee or California trust, then that can cover all of your properties in all 50 states and U.S. territories. So a trust is valid in all 50 states and U.S. territories. If you move to another country like Canada or Mexico, all bets are off, but my best wishes to you. Yes?
What about the wills and trusts and this same type of plan, do they grandfather? In other words, if the laws change, do they automatically change the trust, or do the trusts stay according to the previous.
So the question that Dan asked was, do trusts grandfather in even if the subsequent law changes? So if you do a trust now and 5 years from now the law changes, so that trust may no longer be valid if it were done 5 years from now, does that invalidate this trust? As a general rule, no. Once a trust is done, if it was valid in 2021, it's going to be valid forever. The only exception to that rule is tax law change. So if you do a trust now, right now the estate tax exemption is about 10 million bucks or something like that. Then if you do a trust now, your tax laws apply when you pass away. So if you pass away now, it's $10 million exemption. If they change that law to $600,000, which it used to be at one point, and you pass away 2 years from now and it's $600,000, then that's what's going to govern. So it's the tax laws in existence when you pass away that will govern what laws apply. And if you guys remember back when they had in 2000 when they changed the tax laws and upped the state tax exemption, there was a particular year where there was no limit. You could pass as much as you want tax free. And gosh dang it, if I don't forget, passed away. Somebody like a Bill Gates type character passed away. What's that? Yeah, George Steinbrenner passed away and his entire estate went tax free because he passed away that one particular year. Had he passed away the year before, the year after, there would have been some estate tax. So anyway, so great question, Janet.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.